Welcome, and thank you for joining us for our event today, Lending and Credit Risk in the Digital Age, Navigating Policy Challenges. I am John Sarushian, Senior Associate Director for Business and Technology at the Bipartisan Policy Center. Digitization has been reshaping our economy for decades, and larger data sets, advanced computing, and emerging technologies such as artificial intelligence have continued to intensify this trend. The financial sector has not been immune to this trend as various financial services are being transformed, which is the topic for today. We will start our event with a pre-recorded fireside chat with Congressman Zach Nunn, then transition to our live panel focused on lending and credit analysis. With that, let's turn to the pre-recorded segment with Congressman Nunn.
Thank you for joining us for the pre-recorded portion of our event, Lending and Credit Risk in the Digital Age. I am John Sarushian, the Senior Associate Director for Business and Technology at the Bipartisan Policy Center, and am joined today with Congressman Zach Nunn, who is serving his first term in Iowa's 3rd District. Congressman Nunn is a 6th-generation Iowan and grew up helping out on his family farm. Prior to joining Congress, Congressman Nunn served in the United States Air Force and on the National Security Council. Congressman Nunn currently serves on both the House Financial Services Committee and the House Agriculture Committee. With that, I'm going to introduce Congressman Nunn. Congressman Nunn, welcome and thank you for joining us.
John, thanks so much for having us and appreciate the opportunity to have the dialogue.
Definitely. And let's start. You have a very interesting background, and there's a lot of questions I can ask from your varied experience, but we're here to talk about financial issues today. So I want to start by looking into the big picture. Talk to us about your hearing from your constituents when you go home to Iowa. How are folks doing economically, and what are the financial issues they're thinking about?
Yeah, John, great question. So I came in just about 10 months ago here, and most people may not realize, but in addition to agriculture, Iowa is a big financial hub. And so Des Moines being a financial services community, everything from small town Main Street banking and community credit unions. We also have one of the largest composites of insurers across the country. A lot of the things that we walked into coming straight into a new election as a freshman on financial services was we had one of the biggest crises in banking issues happen when 3 major banks all got hit at the same time. And as we saw with Silicon Valley Bank, we're looking at complete collapse. This had a ripple-on effect, both in my hometown community, where our small banks and credit unions were looking at potentially having a large FDIC assessment, to what was happening to many of my large financial institutions who were looking for confidence in the market. So the good news is within kind of our opening days, we had some really big issues that we got to tackle. But on a day-to-day issue, the things that impact my community are the same that impact communities across the country. We have high gas prices. We have interest rates that continue to climb and are basically pushing first-time home buyers or even a car buyer out of a market. We have a challenge with the, everything from fentanyl that's coming in from China through Mexico and our porous border, as well as just a sense of overall national security, whether it's, the conflict that's currently raging on the southern border of Israel or the influx of illegal immigration coming from the southern border of the United States. Equally, I think there's a lot that we are learning from our district. We have gone out repeatedly. I serve on the Ag Committee as well. And we've done several farm tours, just talking with Ag community and how that has a ripple-on effect throughout the entire Midwest and ultimately the supply chain for the rest of the country. All of these things have a very important, and I would offer, bipartisan nexus when it comes to financial services, to Ag, for what we're doing for national security. And there's good cooperation on both sides of the aisle and even both sides of Congress to be able to move forward on a number of these issues.
Good to hear there's some bipartisanship, as we're the Bipartisan Policy Center, and good to get a broad overview of sort of the issues that you're thinking about and working on in Congress. So during this event, we're going to discuss one particular dimension of financial services, because financial services are a very broad area, which is the increase in use of digital technology in the financial sector. It's one thing to talk about high level about digitization financial services. It's another thing to see it up close. I'm curious, given your work on the Financial Services Committee and your conversations back home, How do you see this trend of digitization playing out, and how is it making a difference in the lives of business owners, farmers, consumers, and other constituents of yours?
Yeah, so in a past life, I served on the National Security Council as director of cybersecurity, particularly on the engagement piece. And we saw digitization really become a huge tool for those who wanted to embrace it, and particularly in the market space. I think we all experienced during COVID the amount of digitization, whether it's being able to work remote like this or having the ability in the financial sector to really move funds in a way that helps serve a new community and new constituents in that community. So you've got obviously what happens in New York and Silicon Valley in the digital space of assets, but you also have what I would call the underbanked or underserved folks in rural communities, including my own here in Iowa. Look, Iowa has a massive community right in Des Moines, which has been on the leading edge of this in tandem with Iowa State, but we also have 19 fairly rural communities, and not all of them have access to that Main Street bank or a large level financial apparatus. Let's not forget, most farmers in America are dealing with millions of dollars going through their processing and having the access to move those commodities in real time. So that's one of the great things where digital assets sits today in this crossroads in the House between financial services, where we have a committee for digitization, as well as in the Ag Committee, which actually owns digital assets. Again, this comes back from the days when we started with the CFTC, really doing commodities that eventually grew into securities. And so for digital asset space, this is one of the areas where there's a great jurisdictional blend between financial services and the Ag Committee. Now, we get to sit on both these committees and the subcommittee for it, so we get a front row seat to how the future of digital assets is going to work. But I think the baseline here is that we want to ensure that we have a safe and secure method for everyday Americans up to major, financial institutions to have access to the best possible technology to really get into safeguarding customers, securing assets, moving in a way that the market moves, and I mean here the commodities piece of it, while also providing every American and the rest of the world a good model to follow when it comes to how a digital asset can work. And that means everything from, just a liquid digital asset to cryptocurrencies to some of the advanced tokens that we're looking at going into it. Where is the U.S. market space going to be? And should the U.S. government be providing some safety rails or guardrails in this area? There's different philosophies of thought on this, on how much government oversight and regulation need to be. But I think that we are reaching a really good space between the CFTC and the SEC in finding an area that allows the innovation to continue to grow and everything from cryptocurrencies to digital assets without having such a regulatory burden that we either crush nascent technology before it really can take off, or worse, push some of this overseas that we've seen, particularly in the crypto space, that then causes some real dangers in who actually has the ability to influence what the future of cryptocurrencies might look like.
Thank you, Congressman. And digitization is a broad space with digital assets being a component of it. Let's move on to sort of issues of credit analysis and lending decisions, given the rise of large data sets and advanced computing, this issue that we're very interested in. So alternative methods for sort of analyzing credit or using larger data sets. There are both opportunities and challenges in this space. I know you're approaching this topic from multiple angles. Can you tell us about the risk and rewards you see with new methods of credit analysis and decision making?
Yeah, so this is an area where I think there's massive growth potential. We're already seeing it in everything from artificial intelligence, machine learning, to actually how we're helping to automate what's happening inside lending institutions. First and foremost, as a guy who has spent a lot of time as a cybersecurity officer in the military, I have seen the growth of innovation in the defense space. And for a lot of those things, we're helping everybody from the woman in the cockpit to the man on the ship really be highly effective in executing their mission set. But I don't think there's ever a full replacement for having a human in the loop when it comes to being able to execute this. It certainly needs to be held true when it comes to our market and financing system. Look, I sit on Capital Markets Subcommittee. One of the things we're seeing there is just a growth in the use of, artificial intelligence to help evaluate and assess what's a good stock pick, where we want to go with a market space. The same is true all the way down to our community lenders and making sure they have the ability to help sort through the myriad of loan applications coming into them. At the same time, we don't want a situation where, the great technology use that's being provided is inadvertently picking winners and losers in this space. We also don't want a burden that is very high for a nuanced user to not have that human interface that actually is provided for some of the best customers that my hometown banks see, as well as some of the most regular and sustainable forces in the market space when it comes to the things like the stock market. These are relationships that go beyond just having technology. And so as we go forward on this, we want to do two things that I think are very important on the Financial Services Committee. We've led a number of bills on this. I'll highlight one, the Financial Protection Act of 2023 that I led with Democrat Congressman Jim Hines. He's the ranking member on the Intelligence Committee. It's also going through Senator Budd and Senator Gillibrand here in the Senate. It's been hotline for it. But it establishes a public and private partnership in this area to really identify what technology is working, what's helping us to move quickly and smartly in this area with a more secure experience for the end user, as well as the entities that are going to be involved in it. And ultimately, it helps make sure that we're not allowing technology to be manipulated for illicit purposes. Think what has just happened within Iran for the stealing of financial services goods in the process, basically skimming it off or creating fraudulent accounts that then allow the ability for a nefarious actor to really exploit these systems. And the truth of the matter is that, as technology advances, so will the level of fraud and, people who are out there for poor purposes to be able to manipulate this technology if there's not the ability for good oversight. And I think that really comes from that public-private partnership where we have experts in the field who are adding to what our regulators can provide as a structure space for effective execution on these.
Great, thanks. I have a question about bipartisanship, but you're bringing up examples of it already, so maybe I'll skip that one. I want to dig a bit more into artificial intelligence. So Congress is looking into it pretty deeply. A lot of the different federal agencies are looking into it deeply. In the context of financial services specifically, do you think Congress and the regulatory agencies are ready for the challenge, or are there changes that need to be made or more resources that need to be allocated?
Yeah, that's a great follow-up question to an evolving battle space. I think contrary to SEC Chair Gensler's comments in the Financial Times, I think it was last weekend, I believe that Congress is up for the task. I think that we have already shown this through Patrick McHenry's leadership in, working on private security when it comes to members' individual information. This is something that he led on in a very bipartisan way with both the House and the Senate. Privacy in the AI environment can be increasingly difficult. It's one of the easiest ways for folks like you and me not only to have our information hemorrhaged, but for nefarious actors to really move out in this space and do real harm to the future of my kids, whether it's their credit score or your checkbook when it comes to how they get your information and exploit it for a future event. I also want to highlight here that Congress, as a large variety of leaders in the cyberspace, AI being part of this, and we need to make sure that we're getting this right and that we're prioritizing it correctly. We have seen this happen in sectors across the United States, and I want to compliment the financial services sector. They've been one of the leading areas in this through groups like the FSISAC to really make sure that we have a good level of information sharing when a threat occurs. Specific to artificial intelligence, right now we're using I think we'll all look back and say this is the front line of ChatGPT and what it could do to revolutionize, writing a book report. But really, this is the impact of the information that we are providing is a mass amount of data being quantified in a way that's readily accessible to humans on a daily basis. Good things come from this. It allows everybody who's a day trader to have a lot more information, even if you're doing it from home. It also means that there are increased challenges and that there's a large segment of the population which potentially could be left behind. From a financial services side of this, as big banks are able to move out effectively in this space and invest a lot of money into the AI and machine learning ML piece of this, we're in danger of leaving the Main Street community bank behind as we hit higher and higher thresholds. And this is an area where I will push back a little bit on the regulatory environment coming out of the administration, which seems very focused on helping major banks or financial institutions meet a mark, and in fact is even driving them to a higher mark for purposes of both security, for the regulatory environment, in some cases for the fine that comes with it. But as a result, we're leaving a massive portion of the financial services industry, particularly in community banking, well behind, with a threshold that most of them are not going to be able to meet. And then that becomes a real additional burden on their financial investment, which, as we all know, then ends up going to a depositor like myself in my hometown to have to pay more in fees. Eventually, you bleed those depositors off and they find other banks to do. And this goes contrarian to what we are hearing from the Fed, the Treasury, SEC, on wanting to really have diversity within the banking and financial space. So I want to make sure that we're looking at it holistically and how it impacts the actual providers of this. And that's where that private portion of the public-private partnership really needs to ensure that their voice is being heard. Something that we just saw with the SEC in a 300-page report that was put out, by the CFPB, overlooks a lot of the things that these community banks need that help on the front end before we can move into the advanced stages that big banks have the financial capability to already execute on.
Thank you, Congressman. So I know you're very busy, so just one or two more questions that I want to get to. You also sit on the Congressional Executive Commission on China, from what I understand.
Right.
Tell us about how the frame of U.S.-China relationship shapes your work on financial services and capital markets, and is there anything you want Americans to know?
Yeah, I have had the privilege of serving the military now for over 2 decades. Flown surveillance and recon missions all over the world, including making sure that adversaries in China are not threatening our allies in Japan, Taiwan, Singapore, Thailand, all areas that I recently just went on with a bipartisan CODEL to really look at the threat coming from China. Certainly in the illicit trade space, China continues to be one of our most aggressive and one of our most advanced foreign adversaries. One of the things that we have tried to do is really look at what we can provide in the China Commission to be able to call out China's bad action. Also offering an on-ramp to Chinese businesses and Chinese people who want to come into market space norms, to provide them a future that really has an integrated system, but always being cautious of what the Chinese Communist Party has done to really manipulate the space. So that's everything from buying up farmland in my home district and across the United States, to buying up real estate, to subverting financial transactions, and in plain sight, doing a lot of the work that is doing real damage to us. After helping evacuate 3,000 folks from Afghanistan as a civilian person myself through Task Force Argo, I'm very sensitive to the fact that China is playing a dark role in the advancement of propping up the Taliban and the terrorism that comes from it. In fact, it's one of the reasons that we worked with Stephen Lynch from Massachusetts on digital assets and exposing China's ability to transfer money to the Taliban in violation of sanctions against China. Additionally, we're seeing China backfill everyone from North Korea to Russia, and now potentially even Iran, which moves that financing on to the Hezbollah and Hamas. One of the areas that we're working on right now with Blaine Luetkemeyer, who's the chair of the National Security Subcommittee, is focusing on revoking Iranian Funding Act of 2023. This is in direct response to a number of things that Iran has done in tandem with countries like China, where they sell most of their crude oil. We're up to 100 million barrels going to places like China in crude oil in violation of sanctions against Iran, and then transferring financial assets back to Tehran so the Ayatollah is able to fund everything from the IRGC, which is the Revolutionary Guards Corps, and Quds Force, their special operations forces in Iran, that train, equip, and help execute some of the actions that Hezbollah and Hamas has taken in a region in the Middle East, which we've just seen through Israel. So these type of tangible implications against China, not only through the financial sanctions, working with our allies in OFAC here in the U.S. government, but also calling out and making very transparent where China is violating international norms, real world security threats by sanctions violation, and in some cases actually emboldening some of our direct kinetic adversaries, in addition to manipulating the financial sector in a way that can be real harmful to consumers right here in the United States.
Thank you, Congressman. And if you have time for one more question, I want to change subjects and bring up the Consumer Financial Protection Bureau, CFPB. The Supreme Court is expected to weigh in on a major case about the funding structure for the CFPB. If the CFPB's current funding structure is deemed unconstitutional, this can have a dramatic impact on the agency. Can you give us your view on the funding structure for the CFPB and what, if anything, Congress should do if the current funding mechanism is deemed unconstitutional?
Yeah, my view on these is the funding agency is unconstitutional as it is not under the appropriations clause. And so that's why I, along with several of my colleagues on the committee, sponsored Chairman Barr's TABS Act that would bring the CFPB into the appropriations process. The concern here, obviously, is that CFPB has no real funding mechanism that Congress has oversight on. And so they get to operate in a space that's fairly autonomous from the type of Article 2 requirements that Congress has the authority to exert over the executive branch. The CFPB should not be able to receive funding directly from the Fed and bypass the legislative body to pursue assets beyond the power of the purse that only Congress has the authority over. And I'm fully cognizant that we must tread carefully when it comes to rulemaking at the CFPB, particularly for what they've imposed over the last 12 years. And not to suddenly just eliminate all of it. That would create destabilization within this space. We need to work collaboratively, not just with the administration, but one, to hold CFPB accountable and start to right this ship. Bring them under the authorities of Congress. If they are going to continue to exist, is a responsibility that the administration and Congress must work on together. But in this interim space, we've got to make sure that CFPB is truly working for not just the American people, but is held accountable to the American people as well before they go out and, I think create some confusion in this space by regulating with very little oversight.
Thank you, Congressman. I wish we had more time to talk, but I think you're a busy person and our time is up. So thank you for joining us and we appreciate your time.
I really appreciate it. Thanks so much, John. Have a great day.
You too. Bye.
Bye.
Hi, we are back live, and I want to thank Congressman Nunn again for speaking with us. Let us now transition to the live portion of the event featuring our expert panel. Before introducing the panel, I want to thank Innova International, who will be featured on the panel for generous support that helped make this event possible. With that, let me introduce our panelists, starting with Kelly. So first, Kelly Thompson-Cochran. She is the Deputy Director at the FINREG Lab. Thank you, Kelly. Next, we have Joe DeCosmo. He is the Chief Technology Officer and Chief Analytics Officer at Innova International. And finally, we have Aaron Klein, who's the Miriam K. Carliner Chair and Senior Fellow at the Brookings Institution. Thank you all for joining us.
Thank you.
Yeah, thank you, John.
Great to be here.
And for the audience, if you're watching online, you can ask questions using the live chat function on YouTube and via Twitter using the hashtag BPCLive. We will try to incorporate these questions throughout the panel, depending on sort of time constraints. With that, let's begin with the first question. I'll start with you, Kelly, but then go through the rest of the panelists. So in a couple minutes, can you tell us at a high level how digitization has been impacting the financial services sector, your specific interest in the topic, and if you want, feel free to react to anything the Congressman said in addition to the first two questions.
Sure. Well, thank you again for inviting me to participate. Digitization is having an impact on a lot of different aspects of financial services. Financial services is always driven by information. And so new forms of data and new techniques for analyzing that data are affecting a broad range of services within the sector. We're focusing in particular on credit underwriting as something that's really important to households and small businesses and communities that are often left out of the financial services system and broader economic participation. And so our work has really been focused on researching recent use of new types of data and machine learning underwriting mechanisms as a way to potentially increase financial access and participation.
Great, thank you, Kelly. Appreciate that. And let's turn it to you, Aaron. So how has digitization impacted the financial sector as you see it? Your interest in the topic, and if you want to react to the congressman, feel free to do so.
Yeah, sure. I mean, wait till the congressman hears about how the Federal Reserve is funded itself, not on appropriations. Maybe he wants to have Congress cut the Fed's budget for research it doesn't like, or if it doesn't like its monetary policy. I think independence of regulation is pretty important. Look, digitization has been giant in the financial services sector. Once upon a time, loan officers looked you up and down, asked the question about whether they liked, the way you looked or who your parents were. And now this has largely become a commoditized industry with tremendous amounts of scale and the ability to handle a lot of information. Some of this is fantastic in providing new opportunities and opening up credit to a lot of folks that didn't have it. And some of it can be a little bit pernicious because at the same time, the same factors that are pushing greater digitization ironically produce more homogenization because everybody wants the same numbers, this credit box, so to speak. The edges harden as the information becomes better, cheaper, faster to put in. It can paradoxically work against incorporating more information and creating alternative metrics to lend, thereby making prices a lot cheaper for those who fall into the box, but making the world a lot worse for those who aren't. So it's been overall a net positive in digitization, but a bit of a double-edged sword. And I think the growth in computing power and information has created a moment where we can harness even more good and fight back against some of the ill.
Great. Thank you, Aaron. Appreciate your sort of opening statement. Let's turn to you, Joe. So sort of your how's digitization sort of transformed the financial services sector as you see it, high level, your interest in the topic, and if you want to react to the congressman, feel free to do so.
Yeah, sure. So, Innova is a digital native. So we were born online in 2004. So we're 20 years into our digitization journey and really have been at the forefront, I think, and early adopter of much of what I think we'll be talking about today, whether it's machine learning, alternative data, all the things that help us continue to expand our products and financial inclusion with our products. So it's an important topic. It's one we want to stay ahead of as much as we can and aware of all the new innovations that are coming and be supportive of the new innovations that are coming as well. I mean, I just made a few notes based on the congressman's comments. I mean, a couple of things that resonated with me, how he described relative to AI, but as we think about it in machine learning as well, is having a human in the loop. That's something we feel very strongly about and is critical for responsible use of some of these new technologies and machine learning in particular. And then the concerns about fraud and cybersecurity. I mean, the same digitization advances that are helping us offer better and a wider variety of financial services to our customers. Fraudsters and criminals have access to some of the same tools, and so we have to keep up with them as well. So those were the two things that sort of stood out to me in the congressman's comments.
Great, thank you, Joe. Appreciate it. Aaron, I'm going to turn it to you, and let's sort of back up a bit. So let's talk about what data has traditionally been used to make credit decisions in the context of this like broader digitization decision. Well, how we traditionally made credit decisions, and what are some of the major regulations that apply to credit decisions currently?
Right. So historically, credit decisions have been based on the basis of a credit score, which is a 3-digit number made to look like your SAT to try to intimidate you that somehow it has validity in meaning. Only in credit scoring and SATs is 800 the goal. What's gone into it is information on the basis of your credit report. That is how you've used credit in the past. The idea, which has some merit at first reflection, is that historical use of credit is a good predictor for future use of credit. So how much credit you have, how much you're using at any given time, how often and when was the last time you've applied for credit, have you been timely on making your payments, have you ever defaulted, have you ever declared bankruptcy? So it's kind of it's a backward-looking set of information reported under the Credit Reporting Act, which then governs those who report data and the to the data aggregator, the credit bureau often. And then the Equal Credit Opportunity Act governs how people then choose credit and allocate credit. One of the key components of the Equal Credit Opportunity Act is, one, there's a set of factors upon which you cannot use on the basis of credit, race, gender, and some things that you may not quite associate off the top of your head, like marital status is one of the factors. And the second point is, if you are denied credit, the requirement that you're told why. And so those are some of the big regulatory laws and highlights. There's a lot more where that came from, but that's kind of the top of the mountain.
Thanks, Aaron, for that sort of like a nice introduction to the topic of credit decisions. Kelly, I'm going to bring you in. So I hear a lot about risk-based pricing. What exactly is risk-based pricing, and why should policymakers care?
Sure. Well, a large number of lenders use risk-based pricing to vary the interest rates that they charge based on the applicant's risk profile. So what it means is that they will charge higher rates to consumers or small businesses that are assessed as having higher rate of risk of default. Proponents argue that this allows lenders to lend to a broader spectrum of people because they're able to cover some of their anticipated costs, and that they're willing to extend credit to people who might otherwise be deemed too risky. Critics argue that it's a self-fulfilling prophecy, that by charging higher rates to the people who are riskier, it can actually make it more likely that they default. And it complicates the entire discussion about new data sources and new technologies, because those decisions and those risk ratings that go into the process not only affect who gets approved, but at what price they get approved. And so that can raise a second set of practical access considerations about kind of the terms of the credit, as well as whether the credit is being extended in the first place.
Thank you, Kelly. And Joe, do you want to react to sort of this risk-based pricing issue, how you guys see it, and what policymakers should sort of take away from it?
Yeah, I mean, look, for us, it's an important topic. It's something we've been using responsibly now for a number of years with our products. And for us, it's about matching the being able to meet the credit needs that the consumer is seeking or small business when they come to us, and provide terms that the consumer or small business can afford. So risk-based pricing allows us to have a wider range of terms and options that we present to the consumer or small business based on our assessment of what they can afford. And so it's an important topic. It's one we continue to develop and improve upon in all of our products.
Great. Thank you very much, Joe. Aaron, do you want to jump in on the risk-based pricing question, or nothing?
Yeah. Yeah, I mean, I guess I would just kind of say, we have a risk-based pricing model in the provision of some credit and not in others, right? Overdraft, for example, is not correlated with risk at all. It's simply just a punitive fee. There are other punitive fees. And so I think there's a tension between risk-based pricing and cross-subsidization, right? So here's a fact. Women are better credit risks than men, but we don't allow that cross-subsidization. Women are also safer drivers than men, and we do allow risk-based pricing for gender for auto insurance. So some financial products lean more towards risk-based pricing, and others lean more towards cross-subsidization, depending on what society says are or not allowable things to price off of.
It's a very interesting point. Thinking of the distinction of when we have risk-based pricing and when we don't. So it's probably a conversation we'll continue throughout this discussion. Joe, I'm going to turn it back to you. So you mentioned Innova is a digital native. Tell us more about Innova, just your company in general, Innova International. What do you guys do, and what makes you different than other financial firms?
Yeah, sure. Before I answer that, just a quick comment on risk-based pricing too. as we're talking about it, to us, that's more than just the APR or the interest rate. It's also the amount, the term or the length of the offer, the ratio of the payment that's proposed to what their income that we've been able to verify. So it's all those things when we look at our risk-based approach to risk-based pricing. So I just wanted to sort of to get that out there as well. So Enova International. So as I said, we're a digital native. We're a leading financial services online lender. We provide both small businesses and consumers that are historically underserved by traditional banks. We provide them with access to fast and trustworthy credit. The combination of small business and consumer, I think, makes us unique these days, both at the scale that we're operating in both of those segments as well. Over our 20 years, we've leveraged really state-of-the-art analytics and now machine learning capabilities with advanced technology to be able to serve more than 9 million customers and provide them with $52 billion in credit since our inception. So, we've had a long run here, and we continue to leverage data science, and technology throughout our entire customer experience with all of our products.
Great, thank you. Next question, I'm gonna ask Kelly, then Aaron, then Joe, if you want to jump in, feel free to do so. So what are some of the opportunities and risks you see with the use of larger and alternative data sets to analyze credit and make loans? You can start with the opportunities, then maybe go to some of the risks in that order. So Kelly, take it away.
Well, as Aaron spoke about, traditional credit underwriting often relies pretty heavily on credit report records, but we know there's a substantial number of consumers and particularly new small businesses that don't have those kinds of records. So it can create a catch-22 for people who are first trying to access credit. We know something like 20% of US adults can't be scored under the most commonly used models for credit scores, and that the percentage is substantially higher among Black and Hispanic consumers than white and Asian consumers. So there's a substantial number of consumers who are just kind of not in the system. If we use other sources of data that are more widely available, that potentially opens access to credit for some of those underserved populations, and for borrowers who've had access to credit but may have damaged, had run into problems over time and have kind of marred credit. So for instance, one of the things that we've studied the most is bank account information, which is much more widely available. There are some consumers who do not have bank or prepaid accounts, but it's a much smaller number than the number who can't be scored or don't have substantial credit records. So that potentially both increases the number of people who can access credit, and also provides additional insight into how they manage their finances and what loans they're able to take on or not. So that's the potential benefit. The risk is that we may have flaws in the data. We may have gaps. It may not be representative, or there can be ways in which data sources are very closely aligned with things like demographics that we don't want to be using in credit underwriting, or that some of the relationships that people may think they're seeing in the data don't really hold up over time. So there's risks that new data sources can be unreliable, can be biased, or otherwise just lead to other forms of exclusion. And it's, the struggle is to get that balance right, really finding new sources of information that can be helpful. Our research suggests that bank account data can be, in fact, quite helpful, that it is predictive and can help it with inclusion and fairness concerns, and kind of as compared to more traditional data sources. And we are seeing more adoption of it, but there's all sorts of issues and other data sources that people are talking about over time. So it's a rapidly evolving environment.
Yeah, I'll jump in and say, if I could snap my fingers and get, kill FICO, that's kind of like what Brad Pitt wanted to do in Fight Club, and get rid of all this credit reporting and migrate everything to average daily bank balance. I think the world would be a better place. Credit would be allocated more fairly and more efficiently. But there are tremendous structural barriers from regulation, from markets that have all built upon this older system. So Alternative data has the opportunity to be more fair and more accurate. Look, my credit report has errors. 1 in 5 Americans have a material error in their credit report. It correlates with having a more common last name. When I find that Aaron Klein in New Jersey who didn't pay his cell phone bill, I'm going to have a few words with him. So there's a lot of opportunity, but there are challenges. Alternative data can be used to proxy for protected class, like race. There are different ways in which you can use alternative data to get around this rules that we have regarding fairness. And the last point I'd raise is I'm a little concerned that we have a bifurcated system where we've grandfathered in some things that have high correlations with protected class, like credit score, and then we hold new alternative data to an impossible test, which is absolute fairness, given there are lots of other structural inequalities. I like to think that if you have something that is more accurate and more fair than the status quo, that we ought to allow progress. But I'm concerned that we have a legal and regulatory structure that grandfathers one group of things which aren't that great, and then holds new information to this much higher, more difficult standard, which paradoxically only reinforces the status quo. So it's a little frustrating that a lot of folks that care very deeply and share my passion about fairness are kind of holding new things to this much higher standard, which has the paradoxical real world impact of allowing a worse system to continue to perpetuate.
Great. Thank you, Aaron. So I'm hearing in terms of opportunities, the big one I'm hearing is inclusion and sort of better credit decisions if we get alternative data sets to work well. And risks, I'm hearing errors in the data is a risk, correlations with a protected class is a risk, and sometimes relationships don't hold. Feel free to jump in if I misstated something. Now, the existing system also has some of these issues as well, such as the point, Aaron, you made about sort of correlation when it comes to existing credit scores may not violate certain laws or certain standards we have. If I stated that correctly, Aaron, feel free to correct me. Let's dive into one or two of these things. So errors. What are some concerns when it comes to specific errors right now that agencies are either looking at or that more can be done on? If people want to comment on that, and Joe, feel free to jump in, maybe telling how you guys sort of prevent errors or deal with errors when they come up. That question's open for anyone.
All I'll say is there's no requirement when you identify an error on your credit report, the credit agency has no requirement to change it. They have no incentive because their incentive is not accuracy. Their incentive is profit, which is smallest cost. And if the errors are symmetric, statisticians will tell you it doesn't matter, it washes out. So the Aaron Klein that didn't pay my bill, right? Try to prove that you're not that person, even though we both lived in New Jersey, right? That's okay, especially because there's been sold to a third-party debt collector who says, yeah, you are. There's only a legal requirement to investigate the claim, not to have any resolution in terms of validity, which is expensive. And so as long as the errors balance out, some people are helped by their errors. Some people have somebody else's credit information in their history who's a good credit, who did pay their bill. There's some Aaron Kleins in California that I think are probably pretty responsible, and they may have helped me in the past. But that's not a system we want where you have as many errors as you want as long as they balance each other, right? That's not the proper system. So hopefully there are better companies out there taking this kind of poor quality information and credit reports and doing something better in allocating credit.
I might jump in here with a few thoughts. There are federal regulations that require credit reporting bureaus to have kind of accuracy policies and procedures and error resolution kind of mechanisms. We know a lot from about 10 years ago when there was a lot of error in the system, but that was the last time that somebody really studied that systematically. And since then, the CFPB has come into existence. They've been examining credit bureaus and doing a lot of things within the credit system. So it's possible that errors have gotten better over time, but there are definitely sources of problems, and particularly when it comes to debts that are being collected by third parties, where it's moved beyond the original creditor, that seems to be a particular source of a lot of problems and kind of garbled information. So the current system definitely has concerns about that. And there's some indication that accuracy issues may be worse with kind of more vulnerable consumers. So it is something that people take very seriously. Some of the new data sources may also have accuracy concerns, as we've talked about. One thing about bank account data is that there's a lot of reasons why people want to keep that data accurate for other reasons. It's even when it's not being thought of or used, primarily in a credit context. But it is certainly a concern as people think about new sources of information, is to make sure that it's actually reliable, because accuracy, errors don't help anyone. It can be difficult and expensive to fix them. And so, the better, the more reliable sources we can find up front, the better off we're going to be on that system. But it's definitely a concern.
Thanks. Accuracy is very important. Kelly, if I can stick with you, you made a comment about sort of one of the challenges also around alternative data or just data sets we use where relationships don't hold long-term, if I'm categorizing that correctly. Can you explain that a bit more, and maybe how a regulator or policymaker would want to think about that, or why they would care?
Yeah, it raises potential safety and soundness concerns, business concerns for the lender, of course, if you're relying on data that doesn't really hold up over time. And I think it's one of the reasons, particularly in the US, why people are mostly looking at sources of financial information as non-traditional data sources. We know in some other countries, people are looking at things like cell phone usage and networks and some digital footprint things. That tends to get used a little less here. I think when it comes to financial data, it's more intuitive as to how it would relate and potentially help to predict whether an applicant is likely to repay a loan. But it's a concern. We get all sorts of data in. There's more and more digitization and new sources all the time. People want to experiment and try and understand what's predictive and what's not. But the farther you get afield from kind of basic financial behavior, the less clear it is. We don't know exactly why that would be predictive, and if it's going to hold up over time, or if it's a consumer behavior pattern that might change for reasons that are completely unrelated. So it's one of the reasons that I think lenders do tend to be somewhat cautious about this, but different people try different things at different times. And so it's always a question that I think people have raised, and federal regulators have, kind of specifically suggested, particularly in the banking system, asking questions about kind of what's the relationship and the intuitive, understanding as to why something might be predictive. So.
Yeah, it's a very, very interesting issue to think about. Jill, I want to bring you in, so feel free to react to anything that was said if you want, but I also want to bring up issues of consumer protection from the perspective of how Inova sort of thinks about it. So what are some of the challenges when it comes to consumer protection that you focus most closely on? How do you make sure you have certain protections in place for the people that you lend to?
Yeah, yeah, I'll address that. I want to comment just very, very briefly on a bit of the other discussion. For us, cash flow based data and underwriting is becoming a workhorse for us, and it's clearly an opportunity for us to expand credit in both our consumer and small business spaces. We have our own internal credit report based credit models, and we oftentimes have decisions where our credit-based credit models say no to an applicant. When we give them the opportunity to provide us with access to their banking data, we're often able to overturn that no decision and turn that no into a yes with a better understanding of our customers' cash flows. We're very pragmatic about data, so we try to focus on data that we think on the front end, theoretically, we'll have a relationship to our default risk. We try not to cast a super wide net when it comes to data we use in our credit decisions. Other areas, fraud, cybersecurity, we do cast a wider net there for sure. But in the credit space, we try to really focus on data that gives us insight into the applicant's actual financial situation. And that cash flow based data, bank-based data has been very, very helpful for us. So talk about consumer protection at Innova, we sort of approach that really from three angles. The first is with our products. So number one, we make sure that our products are fully compliant with all the regulatory frameworks where we operate. So that's number one for us. We also make sure that our products are transparent and easy to understand for our consumers and small businesses. We operate without hidden fees or charges. We provide resources through our products for helping customers save and budget better and ultimately improve their financial condition. And finally, we provide flexible payment options and accommodations when customers need it. So that's number one. The second is in the area of underwriting. And so again, the responsible use of machine learning and risk-based pricing in our products, as I said at the top of this, allows us to offer our customers the credit they're seeking at terms they can afford. That's very, very mission critical to us. And then the last piece is related to fraud and cybersecurity. So we make sure and we have invest heavily in our fraud defense and in our cybersecurity so that we not only protect our customers' data throughout the relationship with them, but we also protect our customers against unauthorized account creations, unauthorized account access, and make sure that we're doing all we can to protect their accounts once they're doing business with us as well.
Thank you, Joe. Appreciate that. Let's move on to sort of the next topic, which is artificial intelligence. So BPC does a lot of work on artificial intelligence broadly, with the financial sector being the area that we have interest in learning more about the use cases of AI and how it's actually being used. Within the even more narrow context of lending and credit analysis in the financial sector, how is AI used exactly, and what should policymakers be thinking about? So you often hear we're using AI, we're using AI, we're using AI. Well, what do they actually mean in the context of credit and lending? And Aaron, maybe you can start with that. We can hear from everyone else.
Yeah, no, sure, John. I mean, look, you're a thought leader and shaped a lot of this conversation in AI. So I know you're a moderator, but you have a lot of wisdom here. Look, we use AI. It's called FICO. FICO is an AI. It's hard to explain. If I apply for a new credit card, is that going to increase or decrease my credit score? I don't know. It depends. There's a lot. So we actually use an AI right now. Now, as I said, one of the requirements is this explainability. So when you define what AI is, what really is artificial intelligence, what isn't, sometimes it comes down to whether or not you can explain to the customer why a decision was made. And you don't have to say, if the machine can say why, it could be one of multiple reasons why, but why, then it becomes more permissible. But I think, again, this is an example of one of these grandfathered systems where we use an AI today called FICO, and that's okay because we used to use it before we had this term AI, and it's pretty sophisticated. And now these new AIs, well, we're going to hold them to this different standard. And you know, but make no mistake about it, FICO meets many of the definitions of AI today.
I guess I'll make one comment. AI in general. AI is not a well-defined term. So what people mean when they say AI differs, from person to person and use case to use case. I'll make that comment. So I think a lot of people think of generative AI today, the more modern incarnation of AI, as a big area. But let me turn to Joe, because I think you probably have some stuff to say about artificial intelligence in the financial sector. And just what's your take? What do you think about when you think about using AI, and what does it mean for public policy?
Yeah, I mean, look, I think the term AI is vastly overused, and again, without much clarity about what we're talking about. So for us at Innova, we view it. We use machine learning, right? So we leverage machine learning. We've been sort of at tried to be an early adopter of machine learning in our decision making for many years now. That to me is applied AI, right? We're trying to make a very discrete decision with a machine learning based algorithm, right? That we think is accurate and allows us to make a sound business decision, whether that's credit or something else that we're doing. So we generally, AI to us really is not something we're focused on. Where when we talk about the generative AI tools, for that, we are looking at those tools really as how they can improve our internal productivity. So how they can make our software developers, our data scientists more productive and effective in their day-to-day work. How our customer service reps can access our bodies of materials and support data more effectively and be able to serve our customers more effectively with those tools. So that's about as close as we get to the generative AI tools. But for us, it's really about machine learning. It's about leveraging machine learning algorithms across the enterprise to make good decisions.
Thank you. And Kelly, you want to jump in on the AI?
Sure.
So maybe talk about that, sir. How do you see it?
Yeah, just a couple of things. So automated decision making has been used for decades in financial services, and it started with logistic regression and machine learning and AI. All of these terms get thrown around a lot. It has gotten more complex over time, and we've seen it spread from early use cases like fraud in particular, more into credit underwriting more recently. And these new generations of automated machine learning models are something that we've been studying. We've been looking in particular at techniques to manage explainability, which Aaron mentioned, and also concerns about fairness, because these models, as they get more complicated, are using more data inputs, a lot of correlated features, and the architectures are more complicated to understand than kind of prior generations of underwriting models. And so that does take some management and careful thought as to how we want to understand and make sure that the models are behaving appropriately and we're managing them. So we've just put out a series of reports on this. It's not generative AI. That is definitely not being used much in underwriting at this time at all. And the other thing to remember is that the data that is being used, especially in the underwriting context, is more carefully curated. It can still have some substantial issues, as we just talked about, in terms of accuracy, representativeness, and everything else, but it is not being trained on the entire internet the way that some generative AI is. And so I think some of the really current talk and debate about generative AI is a little bit different in focus than what we're talking about in underwriting. That said, it's still really important to get it right, because this is such an important use case, makes such a difference to consumers, to households and small businesses, and to the lenders, that we want to make sure these models are, robust, that they hold up when, economic circumstances start to change, that they're fair, and that we can provide, transparency to consumers and applicants about what decisions are being made, why they're being made, and how they potentially can increase their chances over time. So we've been looking at a number of different techniques that are emerging to manage some of those things, and I can talk more about that if you're interested.
Great.
Yeah, and I would just add, John, the one point I would want to reiterate is for us, what responsible machine learning means that we have human supervision at every step of that process, right? So we have our data scientists involved in the creation of the samples that we use and the data that we gather and curate for the models. We have our legal and compliance teams in the loop from the beginning. We review output and iterations of the models throughout. We do independent validations and testing of those models before they go into production. And then we have very comprehensive governance and monitoring of those models once they are live and in production. And so those things to us are all part of, when I say responsible machine learning, this is what I mean, right? That we've got, it's not just a set it and forget it model that runs and learns itself and keeps going. We have humans, as the Congressman said, humans in the loop at all steps.
Thank you all. Yeah, so the topic of artificial intelligence as it evolves, I think it's very important. Again, people use the term different ways and different applications to mean different things. I think that's probably pretty important for the audience to understand. When people say AI, they might be saying different things. This is one reason which I hear a lot about definitions, which I don't think we have a fair definition. I like to joke that the term AI was coined in the 1950s, and we still haven't agreed on what it actually means in practice. With that, we are a bit over time. If the panelists are okay, I'm just going to ask one more question to sort of end this panel. In the next 5 to 10 years, as sort of, we see technology evolve and the financial services sector evolve, give a 1-minute take about where you hope we could be in the financial services sector and what it would take to get there. And maybe I'll start with you, Aaron, then go from there.
Sure. Look, I think in the next 10 years, what I hope is that we've developed a financial services system that attacks the cause that the less money you have, the more money it costs to access money. We have a financial services system that's become a reverse Robin Hood in a lot of ways and is predicated on outdated assumptions like you always have $1,000 cushion, income is stable over time, and all sorts of other things. I thought Kelly made a really good point early on about the distinction between small business and old business when it comes to new business, right? All new businesses start small. That means they don't have 3 years of history. And so we have a system where if we have foundational change, we can create a tremendous amount of savings and new opportunity for a group of people that are currently poorly served by the existing infrastructure.
Yeah. And let's move on to Kelly next.
I like Aaron's vision. I think, specifically in the credit underwriting space, I think getting through the transition to using bank account data more generally, that means not only setting some of the guardrails for how that data flows around the system, addressing some of the technical barriers and competitive barriers that are making it difficult to access today, and helping lenders of all sizes figure out how to use the information in ways that lead to responsible and more inclusive lending. There's a lot to do, and machine learning is potentially part of that as well. There are a lot of pieces both in market practice and public policy that have to evolve to really support those systems. So I think it's going to take broad action from the entire ecosystem, not just one lender at a time trying to figure it all out for themselves, but potentially we could get to a much more inclusive system with those changes.
Thank you, Kelly. And Joe, I'll give you the last word on this question.
Yeah, I mean, I would sort of echo a few of those points that Kelly said in terms of innovation and access, and that, we 10 years from now still have a market that preserves access to credit to the underserved consumers and small businesses that we see every day. Innovation, data access, pricing, risk-based pricing, all those things, right, to us provide are critical components to preserving access to credit.
Thank you, Joe. And with that, I just want to thank all our panelists for this very fascinating discussion. I certainly learned a lot. I also want to quickly sort of thank BPC staff who made this event possible: Michelle Kumar, Joshua Joe, Emily Burns, among many others. So thank you all for participating in this discussion, helping make this event happen. Finally, I want to thank the audience for joining us, since this event would not be possible with you all. With that, I'm going to close the event and thank you all again.
Thank you.
Thank you.